top 10 greatest financial disasters in history. Human history is defined by two fundamental talents: our ability to create breathtaking art and philosophy, and our unparalleled genius for inventing new, exciting, and absolutely catastrophic ways to lose all our money. We are the only species that can look at a common garden flower, a swampy piece of land, or a string of digital code and turn it into a financial weapon of mass destruction. So grab your wallet and hold it tight. Today, we're not just listing the disasters, we're walking through the wreckage and telling the tales of the people who lived through them. This is a grand tour of financial folly, the top 10 greatest financial disasters in history. Number 10. Tulip Mania. We begin in the 17th century Dutch Republic, a global superpower built on trade and rational economics. But for a few years, they succumbed to a floral fever dream. The object of their affection? The tulip, specifically the broken bulbs, whose vibrant striped patterns were the result of a mosaic virus. They were paying a premium for a diseased plant. At the height of the mania, a single bulb could be traded for a canal-side mansion. But to truly grasp the absurdity, consider this legendary anecdote. A foreign sailor, having just helped unload a wealthy merchant's cargo, was given a beautiful Semper Augustus tulip bulb as a thank you. The bulb was worth around 3,000 guilders, enough to feed an entire ship's crew for a year. The sailor, having never seen such a thing and thinking it was an exotic onion, promptly took out his knife, peeled it, and ate it for lunch with his herring. The merchant, upon discovering this, nearly had a heart attack and had the poor sailor thrown in jail. This single event perfectly captures the mania. One man's lunch was another man's life savings, and neither of them was truly sane. When the market inevitably collapsed, fortunes built on these fragile petals vanished overnight. Number 9. The Mississippi Bubble. Across the continent, France was drowning in debt from its royal extravagance. Enter John Law, a charismatic Scottish economist and convicted murderer on the run. He sold the French regent on a revolutionary idea: paper money. He established a national bank and began issuing notes backed by the supposed boundless wealth of France's Louisiana territory, managed by his Mississippi Company. Law was a master marketer, describing Louisiana as a biblical paradise of gold mines and jewel-encrusted mountains. The reality was a malarial swamp, but the French public bought the hype completely. The demand for shares was so intense that the street where the company's office was located, the Rue Quincampoix, became a permanent chaotic mob of investors. The best anecdote from this period tells of a hunchbacked man who realized his physical deformity could be an asset. He began renting out his back as a portable writing desk for brokers to sign contracts on, earning a small fortune in the process. When a man's back becomes a valuable piece of financial real estate, you know you're in a bubble. When the truth about Louisiana's lack of gold got out, the paper money and shares became worthless, plunging France into economic ruin and forcing John Law to flee for his life. Number 8. The South Sea Bubble. Seeing the frenzy in France, the British, in their infinite rivalry, decided they needed a bubble of their own. The South Sea Company was granted a monopoly on trade with South America in exchange for taking over the British national debt. The only hitch? South America was controlled by Spain, Britain's mortal enemy. So the company's primary business model was non-existent. But that didn't stop the public. Share prices exploded, and a wave of bubble companies emerged with increasingly ludicrous business plans. One company was famously created for carrying on an undertaking of great advantage, but nobody to know what it is. People lined up to invest. The most famous victim of the South Sea Bubble was Sir Isaac Newton, a certified genius who calculated the laws of motion. Newton initially invested, sold his shares for a 100% profit of £7,000 and walked away. But as he watched his friends get even richer, he was overcome by FOMO and jumped back in at the very top of the market. He ultimately lost £20,000, a devastating sum today, a king's ransom back then. It led him to lament, "I can calculate the motion of heavenly bodies, but not the madness of people." When a man who understands the universe gets financially pantsed, nobody is safe. Number 7. The Panic of 1837. In the 1830s, America was a nation high on manifest destiny and cheap credit. A massive land speculation bubble was inflating, particularly in the West. But the madness was perhaps best exemplified in New York City, where speculators were buying and selling city lots that were literally underwater in the harbor, convinced they would one day be prime real estate. The bubble was propped up by wildcat banks that printed their own currency with little to no backing. President Andrew Jackson, a populist with a deep hatred for paper money, decided to end the party. His Specie Circular of 1836 demanded that all government land be bought with gold or silver. This pricked the bubble. On May 10, 1837, the dam broke. New York banks, drained of their gold reserves, suspended specie payments, refusing to redeem their paper notes. An anecdote of the time tells of Philip Hone, a former mayor of New York, who wrote in his diary about the melancholy forebodings and the terrible excitement as crowds of frantic citizens mobbed the locked doors of the banks on Wall Street, holding fistfuls of paper that had been a fortune yesterday and was now just kindling. The ensuing 6-year depression was a brutal hangover from a decade-long bender of speculative greed. Number 6. The 1929 crash and the Great Depression. The Roaring Twenties was the ultimate party, and everyone was invited to the stock market. The mania reached such a fever pitch that it became a national pastime. The quintessential anecdote of this era belongs to Joseph P. Kennedy Sr., father of JFK. A shrewd and wealthy investor, Kennedy was getting his shoes shined one morning in 1929 when the young boy shining his shoes started offering him stock tips. The boy excitedly told him which stocks were hot and which ones to buy. Kennedy walked away, went to his office, and immediately began selling off his entire portfolio. He later recounted, "When a shoe-shine boy has stock tips, it's time to get out of the market." He reasoned that if everyone, down to the last amateur, was in on the game and speculating with borrowed money, then there was no one left to sell to, and the slightest breeze would knock the whole thing over. That breeze became a hurricane on Black Tuesday, kicking off the Great Depression and proving that the moment investing becomes the national conversation at every level of society, you're not in an economic boom, you're at the peak of a bubble. Number 5. The Weimar Republic hyperinflation. To understand the psychological horror of hyperinflation, you must look beyond the billion-mark banknotes and into the daily lives of ordinary Germans. An often-told anecdote describes a man who went to a bakery with a suitcase full of money to buy bread. He left the suitcase outside for a moment, and when he returned, he found that a thief had stolen the suitcase but left the pile of worthless money behind. The container was more valuable than its contents. Another story, documented by the writer Pearl S. Buck, tells of a family who had diligently saved for years to buy a house. They had finally saved enough, but they waited one more day to sign the papers. By the next morning, their entire life savings was only enough to buy a single loaf of bread. The speed was dizzying. Patrons in cafes would order 2 cups of coffee at once because the price was guaranteed to be higher by the time they finished the first cup. This wasn't just an economic crisis, it was the complete breakdown of social trust and the very concept of value. Number 4. Black Monday. The 1987 crash was different. It was a cold, digital, unhuman panic. The anecdote here isn't about a person, but about the machines themselves. Traders on the floor of the New York Stock Exchange described the day as a surreal nightmare. They were watching the ticker tape, seeing prices fall at a rate that was simply impossible in a human-driven market. It was the dawn of computerized program trading, where algorithms were programmed to sell assets automatically when certain price points were hit. One trader recounted looking at his screen and seeing the S&P 500 futures just break. The numbers were moving so fast they were a blur. The machines were feeding off each other's sell orders in a feedback loop of pure electronic fear, executing trades in milliseconds. The humans on the floor were reduced to helpless spectators, watching the monster they had created rampage through the market. The Dow dropped 22.6% in one day. It was a terrifying glimpse into a future where our own financial creations could operate with a logic and speed far beyond our control. Number 3. The savings and loan crisis. This crisis was a slow-motion heist, and its poster boy was Charles Keating. Keating ran the Lincoln Savings and Loan Association, which he transformed from a sleepy local bank into his personal piggy bank. He used federally insured deposits, money from ordinary savers like your grandparents, to fund his lavish lifestyle, build opulent hotels in the desert, and make high-risk junk bond investments. The most infamous anecdote involves his sales tactics. When regulators were closing in, Keating had his bank tellers push worthless junk bonds on their elderly customers, telling them the bonds were as safe as government-insured savings accounts. Thousands of retirees, trusting their local friendly banker, invested their life savings. One elderly widow, after losing everything, confronted Keating and asked what she was supposed to do now. His reported response was a callous, "You just have to get over it." Charles Keating's story and his eventual conviction exposed the rot at the heart of the crisis, a toxic mix of deregulation, political corruption, and shameless greed that left taxpayers with a $150 billion cleanup bill. Number 2. The dot-com bubble, 2000. Nothing captures the glorious cash-burning insanity of the dot-com era better than the story of Pets.com. Their business plan was to sell pet supplies online. Their marketing plan was a sock puppet dog. They raised over $80 million in their February 2000 IPO. They then proceeded to spend a fortune on advertising, including a multi-million-dollar spot in the Super Bowl. The problem was they were selling huge, heavy bags of dog food at a loss because the shipping costs were often more than the product itself. But in the dot-com world, profits were a quaint, old-fashioned idea. All that mattered was brand awareness and getting big fast. The Pets.com sock puppet became a national icon, appearing on talk shows and in parades. But an icon can't pay the bills. Just 268 days after their IPO, the company collapsed, having burned through over $300 million in capital. The company became a legendary punchline, a perfect anecdote for an era when a good mascot was considered more important than a viable business. Number 1. The 2008 Global Financial Crisis. The 2008 crisis was a complex beast, but it all started with a simple, rotten ingredient: the subprime mortgage. An anecdote from author Michael Lewis's book, The Big Short, perfectly illustrates the madness. He tells the story of a mortgage broker in California who described approving a home loan for a Mexican strawberry picker. The picker made only $14,000 a year and didn't speak English, yet he was approved for a $724,000 mortgage with no money down. The broker just had him sign the forms with an X. This wasn't an isolated case, it was the business model. These toxic loans were then bundled up and sold as safe investments. The final iconic anecdote is the weekend of September 12, 2008. The CEOs of every major Wall Street bank were locked in emergency meetings at the Federal Reserve Bank of New York, desperately trying to orchestrate a last-minute rescue of the investment bank Lehman Brothers. They failed. On Monday, September 15th, Lehman declared bankruptcy. News channels broadcasted the now famous images of thousands of employees streaming out of Lehman's headquarters, carrying their belongings in cardboard boxes. It was the moment the abstract crisis became terrifyingly real, signaling that no institution was too big to fail and that the entire global economy was now perched on the edge of a cliff. From a sailor eating an onion to a banker selling a mortgage to a strawberry picker, the details are what make these stories so timeless. They remind us that behind every terrifying stock chart and every billion-dollar bailout are simple, human stories of greed, fear, and the unshakable belief that this time it's different. It never is. The only question is, what will the next story be?